Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Senior Currency Analyst at MUFG. It's Friday the 21st of March 2025, and joining Lee to post some questions on the financial market themes for the week ahead is Seiko Kataoka-Fisher, Vice President from Japanese Customer Sales for EMEA in London. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hi, Lee.
Hi, Seiko.
It has been a busy week of central bank meetings. What were your main takeaways from the BOJ and Fed meetings for the FX market?
Yeah, like you say, it has been a busy week this week for central bank meetings. I think one of the main takeaways from both the Fed and the BOJ meetings was that both the Fed and BOJ kind of expressed concern over the high level of uncertainty right now. Obviously, we're still waiting to see President Trump's plans for reciprocal tariffs and tariffs on sectors such as oil, semiconductors and pharmaceuticals. Where those details are expected to be announced in early April, perhaps from the 2nd of April. So really, I think the Fed and the BOJ were both kind of expressing kind of unease over uncertainty until they have obviously greater clarity over what policies he's going to announce in early April. For the BOJ, that obviously made them more reluctant this week to send a stronger signal over the potential timing of the further rate hikes. We still think the fundamentals in Japan are supportive for further policy normalization in Japan. This week we saw, again, some further stronger inflation data from Japan earlier today, and alongside the recent evidence of stronger wage negotiations for next year in Japan, that should give the BOJ more confidence to hike rates further. But obviously, the BOJ wants to wait to see the details of those tariff plans before they commit more strongly to hiking rates. So for now, we're kind of still comfortable with our forecast for them to hike rates again at the July policy meeting, but do kind of acknowledge the risks that they could potentially go sooner at the June meeting. And obviously, we think if they were to do that, that would kind of reinforce the stronger yen that we've seen at the start of this year. For the Fed, I think the policy details were more interesting in that if we look at how Chair Powell was kind of describing the Fed's likely approach to higher inflation from those tariffs, he was indicating that the Fed would see that pickup in inflation this year as largely kind of a transitory effect, and that they expect inflation to drop back in the following years. So it's a kind of a signal to the market that they would be willing to kind of look through higher inflation this year from the tariffs, and that potentially put more focus on the disinflationary impact further out from the negative impact to growth in the US. So we did see obviously quite a big downgrade to the GDP forecast for this year. And I think the Fed as well is anticipating that we will see some loosening of labour market conditions through the rest of this year, with the unemployment rate expected to rise up towards 4.5%. Obviously, if that does start to materialise, then I think the Fed would look to resume rate cuts later this year. Our own view is that we think they'll cut rates again in June, but I think for that to happen, we need to see more evidence of the unemployment rate rising from here going forward. And like I say, for the dollar, I think the dollar, as we've seen in recent months, has weakened, and I think that is partly driven by this downgrade to growth expectations in the US, which the Fed was obviously acknowledging this week.
And we have also seen the BOE hold their interspersed meeting this week. The focus will now shift to the UK government fiscal statement in the week ahead. What are you expecting from it?
Yeah, I think just starting obviously with the Bank of England meeting this week, we did hear from the Bank of England where they indicated as confident, or they didn't want the market to fully price in another rate cut meeting. think the majority of members there were kind of indicating that they're not on a kind of preset course to cut rates in the next couple of months. So obviously by indicating that, it was a signal maybe a bit more hawkish than the market was anticipating. We still think that they will cut rates in May, but I think as we go forward into the summer, we'd be more, I guess, have less confidence that they would cut rates again at the August meeting. I think by that point in time, inflation could be closer towards 3.5%. So moving even further above the Bank of England's inflation target. So it's going to be obviously more difficult for them to communicate additional rate cuts at that point in time. So we have seen the UK rate market move to price out the probability there of another rate cut by the August meeting, which is helping to lift short-term yields in the UK and offering more support for the pound. But like I say, the market is going to be more focused, particularly in the week ahead, on the release of the latest inflation data from the UK and also the government's spring statement. Like I say, with the Bank of England indicating it's not a done deal, they're going to cut rates in May. Maybe those events and data will have even more impact on market expectations next week. Our own view in terms of the spring statement is that we think the government will have to acknowledge that the fiscal position is going to be worse than they had anticipated, and that they may have to announce additional savings of about £10 billion next week. We think half of that will be covered by cutting back on welfare spending, and then another kind of £5 billion they'll have to find savings elsewhere. In terms of how that impacts Bank of England policy thinking, we don't think it will be that significant in terms of Bank of England plans for this year. I think a lot of the savings that the government looks for in terms of cutting spending, that's more likely to be kind of backloaded towards the end of the forecast period. So the near-term implications for growth in the UK should be more limited.
Thank you very much, Lee.
Thank you.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe, and contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.